Hi, thanks for joining. I am Don Ranatunga, licensed real estate broker in Ontario, Canada. One of the questions that I regularly hear these days is regarding how interest rate changes affect home prices. This video is a simple explanation to this rather complex question and is not intended to be investment or legal advice. So just to give some basic background, the Bank of Canada, or BOC, has a mandate of maintaining inflation, which is the rate of increase of prices of overall goods and services in a market, at 2%. The Bank of Canada can influence inflation rate by changing what is known as the overnight rate, also known as interest rate. Overnight rate dictates all main Canadian banks to lend funds to each other at the end of each business day at that rate and maintain a federally mandated minimum amount of money at each bank. When the Bank of Canada decides to increase the interest rate, it becomes more expensive for banks to maintain that minimum money reserve, and the banks pass this expense to their clients by increasing prices of their products such as mortgages and other loans. Therefore, when the Bank of Canada increases interest rate, mortgage interest rates offered by banks also increases. The implication of this is complex. When mortgage interest rates increase while average salaries or earnings of consumers like you and I remain the same, our affordability decreases. For example, if I was able to borrow $100,000 at 2% interest, and if the mortgage interest rate increases to 4%, I may now only be able to afford to borrow $50,000. Reduced affordability of consumers imposes a downward pressure on home prices in the market, and it is likely that over a time period home prices could come down. Although this is a general outlook on how changes in interest rate affects home prices, there are other factors at play that could further affect real estate markets. So as I explained above, it may be easy to comprehend the direct relationship between interest rate by the Bank of Canada, mortgage interest rate, affordability of consumers, and how it affects home prices. However, market behavior with interest rate changes can be more complex. Changes to the interest rate by the Bank of Canada also affects other loans by banks, such as business loans, and it becomes more expensive for investors to borrow when the Bank of Canada increases the overnight rate. This affects the availability of capital or money for investors, and in return it affects the demand for investments. So for example, when interest rates increase, new home builders may stop or reduce starting new building projects. This could decrease the housing supply in the long run and cause to increase home prices. Furthermore, when the Bank of Canada increases the interest rate, some investors that were planning on purchasing real estate may decide not to do so since it's now less profitable. They may find other competing investments, such as investing in stocks or bonds, more attractive. This can reduce the demand for real estate and actually decrease home prices. So in summary, when the Bank of Canada increases overnight rate, such as what we have seen over the past few months in Canada, real estate prices tend to decrease, at least in the short term. However, it is difficult to predict how the real estate market would behave in the mid to long term, since many other factors such as world economic growth, immigration rates, birth rates, unemployment rates, regional conflicts, etc. could have a significant impact on its behavior. So thank you again for watching this video, and I hope it helped you to understand how the interest rate changes by the Bank of Canada affects real estate market. Please feel free to contact me anytime if you have any questions regarding this video or anything regarding real estate in Ontario. Wish you all the best.